All right, let's dive right into this explainer and uncover the definitive step-by-step framework for performing top-down analysis like an actual institutional detective. If you've ever opened up a chart and just felt instantly overwhelmed by the absolute chaos of candlesticks, you are definitely not alone. But today, we're stripping away all that noise. We're going to build a solid, overarching market narrative so you can pinpoint exact, high-probability setups without all that second-guessing. We've got to start with a pretty staggering statistic that just constantly plagues the markets. Why exactly do 99% of retail traders fail and just consistently hit their stop losses? I mean, it's not because they lack some secret holy grail indicator, and it's certainly not because they don't know how to draw a basic support line. The simple truth, they just don't know how to read the actual story the market is telling them. And that's exactly what we see happening time and time again. They fail because they get completely lost in lower time frame noise. You know the type, they zoom way in on a 5-minute chart trying to predict the absolute top or bottom of a move, and they completely miss the overarching macro direction. When you don't understand that larger market structure, you end up trading straight into massive momentum shifts. It's basically like jumping into a 2-foot pool and expecting to go for a swim. So here's our roadmap for this explainer. First, we'll look at the retail trader trap, then the time frame hierarchy, reading the market's heartbeat, hunting institutional zones, and finally, timing, liquidity, and execution. Okay, part 1, the retail trader trap. Let's talk about escaping the blind support and resistance game. Notice the stark contrast here. Retail traders absolutely love to blindly buy or sell at those obvious support and resistance lines, but think about the real story behind the move. Institutions need massive liquidity to fill their huge orders, right? So how do they get it? They engineer aggressive moves that sweep right past those obvious retail support levels, triggering an absolute cascade of retail stop losses. Smart money is literally using those trapped retail traders to build their own positions before launching the market in the direction they actually want to go. Moving on to part 2, the time frame hierarchy. This is all about building your trades on a solid foundation. Think of the top-down mindset kind of like constructing a house. Your weekly time frame, that's your concrete foundation. The daily is your cement blocks holding up the walls. The 4-hour is the concrete filling out those blocks. And the lower time frames, like the 15-minute or the 5-minute, that's literally just the interior design. You can pick out the nicest marble countertops for your 5-minute chart, but if that weekly foundation is crumbling beneath you, your entire trade is going to collapse. You absolutely have to build your narrative from the top down. I love this analogy. You can drive a car, a truck, or a motorcycle, but you still have to follow the speed limit. Listen, it doesn't really matter if you identify as a rapid-fire scalper, a day trader, or super patient swing trader. The higher time frames dictate the ultimate rules of the road. The strategy or the vehicle you use is entirely up to you, but the macro direction of the market, that's the law. Section 3, reading the market's heartbeat, the ABCs of market structure. Think of these points as the literal ABCs of your trading language, basically mapping out the heartbeat and the blood pressure of price action. A bullish market consistently pumps out higher highs and higher lows. A bearish market gives you lower highs and lower lows. And when we map this structure, we want to rely on the actual candlestick bodies to confirm the move, not just the wicks. Most importantly, when you're hunting for an area of interest to enter a trade, you have to look inside the current higher high and higher low. If you're buying when price breaks below a higher low, you're literally buying into a market that just shifted bearish. Now, this brings us to a massive mistake traders make, ignoring trend relevancy. So many traders will find this beautiful 4-hour supply zone, immediately drop down to a 1-minute or 5-minute chart, spot a tiny reversal, and go all in. But guys, a 5-minute structural change means absolutely nothing if that 4-hour trend is aggressively pushing against you. You've got to use a logical one-step-down approach. If you're analyzing the weekly, step down to the daily. If you're on the 4-hour, step to the 1-hour. You have to keep your timeframes relevant so you don't get chopped up by lower timeframe noise. All right, part 4, hunting institutional zones. Let's learn how to follow the smart money footprints. To do this right, we need to totally understand the concept of liquidity sweep. As we touched on a minute ago, institutions literally need trapped retail traders to generate the massive liquidity required to fill their massive positions. They'll intentionally push price past an obvious high or low, sweeping those stops before just aggressively reversing the market. When you see this happen, it's an incredible clue. It tells us exactly where smart money just entered the chat. So here is your exact hunting checklist. First, look for extreme zones. These are supply or demand blocks at the very top or bottom of a move that haven't been retested or mitigated yet. Second, spot those imbalances or fair value gaps where price moved so violently it just left open space on the chart. Third, verify that a liquidity sweep just happened nearby. And lastly, ensure that the whole shebang perfectly aligns with your higher timeframe directional bias. By checking off these specific footprints, you stop guessing and you start trading the real narrative. And finally, Section 5, timing, liquidity, and execution, putting all this detective work into practice. Here is how a complete execution plan actually comes together. First, we confirm our daily direction. For instance, making sure price is clearly trading above the 13 EMA for buys. Second, we drop to our 4-hour setup and we patiently wait for price to pull back and tap into one of those validated extreme demand zones we just learned to hunt. And finally, step 3, only after that higher time frame zone is tapped do we drop to our 5-minute entry time frame to look for a definitive structural shift and a 1350 EMA crossover. We don't predict. We let the higher time frame give us the zone and the lower time frame give us the trigger. Now, your setup could be technically flawless, absolutely picture perfect. But if your timing is wrong, you're still going to lose. Think about the London or New York Opens. That's high probability conditions where massive institutional volume lives. But if you try to force a trade during the Asian session, you're usually just dealing with low probabilities, sideways ranging chop. And trying to hold a setup right through major red folder news like CPI or NFP, that is pure danger. Economic data can entirely override your technical setup, causing massive slippage that skips right past your stop loss. Timing really is everything. And speaking of everything, here is a golden rule you can never forget. Always look to the left. Honestly, so often you'll spot what looks like an incredible 5-minute reversal. You hit buy and price immediately dumps. Why? Well, because you didn't look to the left on the daily chart to see a massive unmitigated weekly supply zone sitting directly above your head, acting like a giant institutional price magnet. If you don't zoom out, you're literally trading blindfolded. Which brings us to our final thought for today's explainer. Take a moment to reflect on your own charts and ask yourself this absolutely crucial question. Are you actually building your trades on a solid higher timeframe foundation, or are you just decorating a 5-minute house that's about to collapse? Top-down analysis isn't just an extra step, it's the entire story of the market. Learn to read that story and you can finally start trading alongside the institutions.